Hello and welcome everybody. Welcome back to Sectors Made Simple. Happy Friday. And we've got another interesting topic for us all to talk about today. Today I want to cover something that you've definitely heard of. Sometimes I'll say you might have heard it or you might see this term come up in the future. No, this one you've definitely seen. Price targets. Price targets is something that every single news publication that covers finance will mention at some point. And they don't always use the information correctly. And by that, I mean sometimes they will be very misleading in how they use it. While I'm not going to go into examples of that today, what I want to do is I want to demystify what price targets are. I want to cover price targets in quite a bit of detail to really go into what information can we get from them. What is the right way to use that information? What is the wrong way to use that information? And what other information do we get alongside price targets? If you just kind of want to get the gist of what this conversation is going to be about, here you go. Price targets are incredibly valuable pieces of information. They are one of the best ways that we can have insight into what a stock's price might do in the future, but it is also one of the easiest pieces of information to misuse, especially when your purpose of using that information is to try and make an argument on either side of an extreme. Whether something is the best buy since sliced bread, or it's the worst thing that you need to dump right now. Somewhere in the middle of all of that is the real reason why price targets are a valuable thing for us to understand and talk about, as well as resources for where you can get good price target and relevant information around that similar topic. Don't want to spoil too much though. So in today we're going to cover price targets and more as we explore what analysts can give us to help us invest simpler. So let's get straight into the action with today's presentation, shall we? Quick disclaimer, I won't talk a whole bunch today about strategies or anything like that, but I will give my opinion for quite a few of these matters. When I give my opinion, it is strictly that, my opinion. I've tried to do as much research as I can to provide as complete a picture as I can outside of my opinion, and try and give you the facts and sources for that information so that there's no sort of, well, he's just biased one way or another. It's not my goal. My goal today is to give you the facts, to give you my opinion of those facts, and encourage you to take that information, do your own research, and make your own opinions. After all, the best way to invest is not the way that I invest. The best way for you to invest is the way that makes the most sense for you. Learn from others, but act for yourself. And past results can never guarantee future performance. That applies to price targets as well. So let's cover what we are going to go through in today's webinar. Hello TechWare, good to see you. And hello everyone who is here with us live. It's great to see you all. If you're watching this recorded, we do all of these webinars live at 4 p.m. Pacific, 7 p.m. Eastern Time on Fridays on our YouTube channel. You can subscribe to stay tuned and get notified when we go live, as well as you can join us on sectorsmadesimple.com. Create a free account, get weekly insights from us on market news and changes, as well as get notifications and reminders for these webinars. All right, sales pitch done with. Let's get into the information. So today we're going to cover price targets, which are a valuable piece of stock information that is widely mentioned. This can range from extremely unbiased and very analytical news sources all the way down to a person trying to explain why SPY is going to fall another 50% because one person said it would. So what I'm really trying to get at here is that many publications and finance personalities and writers will use price targets as a way of trying to predict or guess how a market or a stock is going to move in time. But what exactly are these price targets? What are they telling us? And more importantly, why do they matter? Why is this something that is so widely mentioned and talked about? And what other stuff do we get? Do we just get one number, take it or leave it? Or is there other stuff that goes on around the price target that we can use to get a better idea of what's actually going on. And of course, where can we find information on price targets and its friends? We're going to answer all of those questions in today's webinar. Oh, Andrew, it's great to see you, man. It's been a minute. Good to see you. Alrighty. Let's first cover the basics of what a price target actually is. It is a target price for a stock. Alright. Thank you all for joining today's webinar. I hope you all got some useful information out of it. We'll see you back next week for... No, I'm kidding. For retail investors, and by retail, I don't mean like retail stores like Target or Walmart and all that. I mean retail investors as in you, me, Juan de los Palotes, the person who is investing for themselves and is really trying to look out for themselves. They're not trying to invest on behalf of other people. When we're investing, we're not looking at the entire S&P 500 and analyzing every single company in it. Instead, we might look at simpler things. We might use technical analysis or fundamental analysis filters. Is it above or below a certain level? What levels are we looking at? Is it within 10% of its 52-week high? Very simple yes or no kinds of questions like that to help us get a better idea of what, but also when, to buy or sell a security. This works really well for us. And okay, really well might be the wrong word. It works fine for us because really we're managing smaller portfolios. We are not going to have millions of dollars to invest where we can spread ourselves as wide as we want to give ourselves a truly diversified portfolio. There are tons of things we can do to diversify our portfolio that isn't just investing mixed amounts into 100 different companies. We're often investing in a handful, and we can manage them by ourselves. But things start to get a little bit more interesting when we get into the world of institutions, portfolio managers, and really the people who go to work and their job is to manage an investment account, either for a group of investors or for the institution or bank that they work for. Their job is to invest. So they need more information than just a technical or fundamental analysis filter. They also have a lot more money to throw at that problem. Enter the world of market analysts. Market analysts are an entire industry for people who really want to get into the numbers. And not just numbers. There is fundamental and technical analysis. And that can be anything from qualitative words to explain information and quantitative numbers to explain information. But when it comes to this world of investment managers, the people who manage or invest for someone else or for a bigger group than just one person, they are going to be highly competitive. For some, how much money they make is directly tied to a proportion of how much return their portfolios generated. Others, you're going to be one investor in an entire group that is managing the portfolios for an institution. As such, it matters how well you do. Every little dollar that you can get an edge over your competitors is huge. So they're going to look for every possible way to maximize their returns. And in addition to that, they also have a lot more money, again, to throw at the problem of, I have the time, I have the resources, and I have the need to find every individual chance I can to maximize my returns. So part of that strategy is not just going to be going into FinViz and doing a screener. It's going to be doing much more in-depth analysis of stocks, their prices today, but also their future prices in not just the near term, but also more long-term outlook as well. The position of market analysts meets this need. These analysts might be a team, a person, and they might be within an institution, so some big fund like Morgan Stanley or Bank of America. They're going to have people in their company who are market analysts. Or they might be third-party organizations that all they do is create these market analysis insights and then sell them. But regardless of if they are working for a company or they are a company, their goal is pretty much the same thing. Use the data that we have, use past stock performance, potential stock performance, and things like future EPS estimates to get a better idea of where they think a stock's price is going to go in the future. Now, we've talked a lot about some pretty big terms here. Institutional investors, market analysis, quantitative analysis, qualitative analysis, EPS forecasting. Before all of this starts to just go wild in your brain, let's just take a step back. Why should I care? Not should I care, why should you care about what I'm talking about? Why should I care about what these analysts have to say? I'm not an institution, I'm investing for myself. Well, because a lot of these analyst groups, institutions included, will publish their findings in reports. These reports are going to look at a wide variety of things. Now, it's not just going to be for a single company. They will likely specialize in a specific industry or a specific sector, and they will do an in-depth look at that sector. Where is it today? What's its profitability? What's the investment looking like going into it? What are the challenges that it's going to face? What are the more macroeconomic considerations that this industry or sector needs to have? What are the global events? Something that I saw when I was researching this, I went through and looked at a bunch of different reports. And there was one that I was reading that, mind you, I didn't buy this because the report cost $4,000. But in the summary of the report, it is titled, "The Impact of Macroeconomic and Global Crisis Trends for Semiconductors Within Ukraine." Pretty lengthy, very, very specific, but that's the kind of stuff that matters when you have the ability to analyze so much data and the need for that much data. We don't care about that much. What we care about, because again, these reports go way beyond anything that we should care about. And also, I doubt that any of us is going to go out, spend $4,000 on a report for the semiconductor industry as it relates to Eastern Europe. One thing that we do care about is the fact that these reports also will give much more simple pieces of information out for free. And part of this, well, two big components of this are going to be the price targets and company recommendations or ratings. First, let's talk a little bit more about price target and actually go into a little bit more about what these price targets are. So a price target is a single price that an analyst finds a stock to be worth. Not today. It's not what do they think the stock's price fair value is today. What they're trying to do is estimate what the stock's price might be in 12 to 18 months. I'll tell you one thing. When it comes to trying to predict the stock market, that is a nearly impossible task. One of the best and most advanced trading strategies there is called high frequency trading, or HFTs. It involves computers that are some of the most advanced computers outside of government or research organizations. And these computers are meant to trade millions of times a second. Because what they try and do is predict what is going to happen in milliseconds or seconds. And for a while, there was a race to see who could buy office space as close to Wall Street as possible, or to the New York Stock Exchange or the NASDAQ as possible. Not because they wanted to just be close to and feel the energy of Wall Street. No. If they're closer to the exchange, that means data that comes out of the exchange reaches them faster, and when we're playing a game of milliseconds here, that matters. A single millisecond or two that you have an edge over your competition can mean millions of dollars in returns. So the reason those strategies work is that they are very good at predicting price changes in an order of seconds. Predicting days? All right, come on. We all have seen the weather reports before. It says it's going to rain this weekend. We all cancel our plans to go to the beach. Sunday rolls around and there's no rain. Market forecasts are not much different. People think they have a decent idea of what's going on. They'll try and guess where they think things are going to go, and it takes a right turn 5 exits too early. So, predicting 12 to 18 months in advance is nearly impossible. It is an impossible task. And I'll spoil this right now for you. It's not always right. Most of the time, it's wrong. So because of this, these price targets are not they market once and then they stop. It's something that they revisit over and over and over. And they'll update what their price targets are over time as new things happen in the world, new information comes out, new products are announced, or other market events and global events occur. But the interesting thing is, price targets, are they right? No. More often than not, they're wrong. But that doesn't stop the fact that they're not going to be creating these price targets. There isn't a point. If there isn't a need. So the fact that they continue to do it means that there is a need for this information, and that this information is being used by institutions, by retail investors like you and me, and financial publications such as opinion pieces on Seeking Alpha, a market analysis recap through Wall Street Journal, anything from major reputable publications all the way down to just a person who wants to share their financial opinion on Seeking Alpha. They're going to quote these price targets as, this is what so-and-so says this stock is going to be worth in 12 to 18 months. Now, should I care? Should we care about price targets? My opinion here, yes. Yes, we should. But not in the same way, and not as much as most publications and articles might want you to think. Here's the facts. Analysts are extremely good at their jobs. They dedicate their careers. Many of them have degrees in computer science, statistics. These are incredibly intelligent people that have dedicated themselves to creating different models, both traditional and machine learning models, to create information like price targets. When there is so much money to be made through institutional investing, and there's such a market for market insights like price target information, there has to be meaning and value behind that information. My opinion is that price targets give us a very great first look at what industry professionals, the people that crunch all the numbers, think a security will be worth. Now, that said, going back to what I mentioned, these analyst estimates, while we should care about them, are more often wrong than they are right. So, how often are they actually right? Because if we're going to try and use this information as part of our decision-making process for what price we want to buy a stock for, or any sort of buy, sell, or hold decision, you need to know what's their batting average. How often are they setting up these price targets, and how often are they right? It's probably lower than you think. So I wanted to find some data. I didn't want to just go, all right, how often is this? You're going to get answers ranging, and none of them are really going to be a full analysis of the analysis. So here's what I was able to find. In 2012, there was a study that was done in partnership between the University of Waterloo and Boston College. And here is what they found. They analyzed price targets from over 11,000 analysts from over 40 countries. And out of all of those 11,000 analysts, only 18% were correct predicting a 3-month price target. And that number does go up to 30% for a 12-month price target. And in addition to that, those numbers are averages. But within all of those estimates, the further the target price was from the market price, the worse the accuracy was. That should make sense. If you're saying that a stock's price today is 100 and that the price target is 150, it's much less likely than saying the price target's at 100, or sorry, the current price is at 100, the price target's 110. So that's the data. The data is 18% are correct in a 3-month target range, 30% in a 12-month target range. Again, that's the data. There is no arguing or saying that it's right or wrong. But here is my opinion, and here's my opinion of that. When I first saw this and read this, it was very interesting to me that the number actually goes up for a 12-month target. Sadly, one thing that this study doesn't clearly show is where were these predictions and what was the accuracy for both a positive or a negative price target. We always say bear markets always subside, bull markets always prevail, market trends upward over time, yada, yada, yada. Things go up over time. So the longer your time horizon that you're looking at is, the more certain you can be about being able to understand what a price, or if you're predicting something is going to go up in a 12-month period, that's a little bit easier to say than in 3 months, because all sorts of things can happen in 3 months. Now, again, does this invalidate the data? Does this say that the data is wrong? No. But to me, if I'm going to look at one of those numbers as this is probably the more accurate one, I'm looking at the 3-month. I'm looking at the 18%. That to me is more likely to be the real average. But either way, again, that's my interpretation of the data. Either way, 18%, 30%. I can take a coin and I can flip it. I have a higher likelihood of guessing which side of this coin it's going to land on than an analyst predicting a stock's target price is actually going to be met or not. So they're more often wrong than they are right. But Jonathan, I thought you said that price targets are good. After all, let's go back. Should we care about price targets? My opinion, yes. How can you go from saying yes, you should care about price targets. Price targets are at worst, or at best, 1/3 of the time right. At worst, 1/7 of the time right. 1/6-ish. 1/6 to 1/7, whatever. Either way, it's not very good. So to explain this a little bit more, let me talk about how I would use price targets. And probably, it's not the only way, it's not the best way, but this is how I look at this kind of information. Because again, I did kind of say that at best, they're 30% accurate. There's one thing that I've left out. Partially on purpose, sorry. It's just good storytelling. Yes, each analyst provides a price target for a company, but that's like asking someone, is it going to rain tomorrow? And having them say yes or no. We can ask 100 different meteorologists, people whose job it is to predict the weather, what they think the weather is going to be. And that's going to give us a better idea of what the weather will be than if we ask just one person. So what will happen is hundreds of analysts will publish price targets for a singular company. And we can take all of these averages, all of these price targets, and just use not crazy statistics. We're not talking about bucks and whisker plots or any sort of like statistical modeling. Just let's go back to middle school. Mean, median, mode, range. The super easy stuff can still give us so much more of a complete picture of price targets and what information actually matters there. There's two in particular that most sources will use. Median. Median is going to give us an average. It is not actually the average, but what it is if we said, all right, the person with the lowest and the highest, goodbye. Second highest, second lowest, goodbye, 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 until we got to the middle guy. That would be the median. The median in this case is a really good way of taking this information because, as we'll see later, the range of some of these forecasts is hilariously large. So we want to ignore how wide the spread is. We want to ignore what we call extreme outliers. If 80% of people are right here, and then one person said, it's going to go bankrupt and it's going to be $0, and one person said, congratulations, GameStop to the moon, $50 million per share. Those are going to mess with the actual average if we'd found just an average. So median tries to ignore those extreme outliers and give us a better idea of what's the middle guy saying. For those worst and best case scenarios, we have range. So between median and range, we get a pretty good idea of what we should expect, or what the area that we should be thinking about is for any of these given stocks. So that is a very detailed look, not at how to calculate price targets. Again, that's not something that I think any of us will really do. And it's not in our best interest to do that. Again, they have way more time, way more resources, and way more experience calculating predictive models like this. Now, there's one last thing for us to need to cover. Recommendations. These are not recommendations like your stock watch list on Wall Street Journal or something. These are an analyst's positions on where they think a stock should be compared to its specific index or group. Rather, where its price target is compared to that specific index or group. These recommendations will range and will follow one of two systems, give or take. And I'll explain that in a second. We will have the weighting system, which is overweight, underweight, or equal weight. and then we will have traditional. This can be either buy, hold, or sell. That was the old traditional. And the slightly newer one is buy, outperform, hold or neutral, underperform, or sell. Let's quickly talk about the differences. Because if you haven't noticed, some of these words you might be familiar with, but I promise you they don't mean what you think they mean, including buy and sell. So let's start off with the elephant in the room. Traditional. Traditional is very much like its name implies, the original standard for company recommendations. It was not the only way, but it was the main way that institutions and analysts would provide their recommendations alongside a price target. Like I said before, these recommendations were originally limited to just buy, hold, or sell. But they realized that these are slightly misleading. If someone tells you, and our recommendation for Tesla is to buy, what are you going to think they mean? Well, they said their recommendation, the analyst's recommendation for Tesla is to buy. Let's buy, right? Not what it's supposed to mean. I know that's what you think it means, but that's not what they actually mean. What is slightly misleading is that these, what we think of as trading actions, the buy or sell kind of decisions, is not what the purpose of these are. So the reason for that is the fact that many analysts, these are not recommendations of buy this now. These are comparing this stock to an index or to a market. So by saying buy, what they actually mean is that it will outperform, it will do better than that market or index. So to try and get closer to what they actually want to say, which isn't we're telling you to buy, we're telling you to sell, we're telling you to hold, they added, well, not everyone, many started adding outperforming or underperforming. That gets a little closer. Neutral means it's going to, or hold is going to mean it's somewhere in the middle. It is performing or expected to perform similarly to the market, whatever that market they're comparing to is. For traditional, it is usually larger markets like an index or an exchange or a market. And what they'll do is they'll say, we think it's going to be neutral compared to this benchmark. We think it's going to outperform it. Or if it goes beyond outperforming, it will reach that buy title. Not because they're saying go out and buy it, but because it is outperforming to a point where their recommendation is, especially if their recommendation is geared towards institutional investors, buy. Same thing on the other side. They'll say underperforming, or if you own it, probably sell it, is what that's meant to say. Now, this is still even tricky, because the reason that you might buy or sell a stock is going to be different if you are you, me, Juan de los Palotes, or if you're an institution. So again, this was not a perfect system. Enter waiting. Waiting was originally, or not originally, but was started to pick up use after the dot-com bubble in the early 2000s. Because they needed an option that was a little bit more equal weighted than traditional. So over the past 20 years, starting with Goldman Sachs, I believe, many institutional analysts and market analysts have moved away from the traditional system of buy, hold, or sell, and have gotten into and tried to avoid, if you've noticed, every webinar, Past results don't guarantee future performance. This isn't financial advice. All of these crazy disclaimers. The reason is the dot-com bubble had a lot of speculation, a lot of people offering financial advice that they shouldn't have been, and there started to be a crackdown on it. And for good reason. And it was necessary. Anyone with the platform, and the internet is a big platform, can share their opinion, and if their opinion is not well researched, or if their opinion is just flat out not true or misleading, that can be really dangerous, especially when someone's money is involved. Now, going back to analysts here, they are not going to be the influencer on TikTok that's trying to push the next big crypto scam or next big NFT scam. But they started to get worried about the fact that they are offering analyst recommendations as buy, hold, or sell. So waiting was an alternate system that gets away from that. They don't use the words buy, hold, or sell. They use equal weighted, underweighted, or overweighted. And instead of comparing to major markets or indices, these, again, there's no rule of what they are compared to. But typically, the weighting system will look at a more relevant benchmark. So these will likely look more at a sector or an industry instead of the broader market like the S&P 500 or an exchange like the New York Stock Exchange or NASDAQ. This system put a lot more emphasis on comparing that future performance, not to a buy, hold, or sell decision, but instead, will it outperform, or rather, is it overweighted, equal weighted, or underweighted compared to its sector or industry? Now, which system is better? Sadly, neither is perfect. If one was better than the other, we wouldn't be having to talk about the two differences. The fact of the matter is, both are still in use, both are extremely common, and both have very good reasons why they are still here. The traditional system is better in the fact that the sentiment, the feeling behind what they're trying to say is so much more clear. Buy is a very strong opinion. Sell is a very strong opinion. That's why some analysts move away from it, is because it has so much meaning behind it. These are actionable words. If someone says, my recommendation on this company is to buy, dang it, you're going to think they're going to buy the thing. If they say that my opinion of the stock is underweighted, what the heck does that mean? Underweighted? All right, just shove some more calories in them. Problem solved, right? Just load them up on some calories. You'll pack on a couple pounds. Take them to an all-you-can-eat buffet. They're all good. Now, again, underweighted can be a tricky term. Because if we think of something like BPI, for example, you might think of something that is oversold. Or even just if you think about the connotation of the word overweight, it's not a positive connotation. It is not, you think of overweight as it's doing good. We are conditioned to think overweight is a negative sounding word. So it's kind of weird. There is no perfect situation here. Overweight and underweighted, they, in our brains, don't make as much sense. We are actually likely to think that overweighted is a bad thing because of the other ways that that word can be used, compared to something like buy or sell. But again, buy or sell is not perfect, because these are not meant to be every single person that has a brokerage account should go buy this stock. But it's less dangerous. If you have to pick one or the other, if you're an institution or if you're an analyst that doesn't want the liability of saying, oh, well, we offered financial advice, they're going to use the weighting system. But both are not perfect. Both have their advantages. So, also, the other side of it also is that weighting, the biggest advantage that I see in the weighting system isn't the fact that it gets away from the more actionable recommendations like buy, hold, or sell. It's the fact that it looks at a more comparable group. It looks at a sector or industry that that company is in, not something like beta that's going to compare itself to SPY or something that is going to be much more broad. So, what is the better system? There isn't really one. Take your pick. Both systems have merit. And there's a reason that I say don't just trust one analyst estimate. Because that analyst is going to use one system or another. And it's valuable to get outside of just one person's opinion. So, what I want to show you next is kind of twofold in that not just one person's opinion kind of matter. I want to show you multiple sources for where you can get price target data and analyst recommendation data. I also want to show you how each one of these sources can provide you with a more well-rounded knowledge, not just one person's or one company's or one analyst's predictions. So where can I find all of this information? If you are here live with us, I will start posting a bunch of links down in the chat. If you're watching this recorded on YouTube, hit the subscribe button, please. It really does help us out. The links for everything will be in the resources. If you're watching this on our website, Sectors Made Simple, hooray, thank you. You'll find the links down below this video in the resources section there as well. So let's go through. Because again, is there one source that's the best for all this information? No. There's a couple of pretty good ones that I want to mention, and they will all offer similar information with better or worse things in each case. So if what you want are price targets and analyst recommendations for a singular company, one of the best places to start is FinViz. FinViz is going to offer you a really interesting look at price target data. If you look up a company, in this case I looked up Apple, and you scroll down, what you will find is you will find all of the different, most recent changes to analyst estimates for this company. It tells you who the analyst was or who the organization was, what their position was, or if the position changed, how it changed. Anything in green means that they upgraded it. It improved. So in this case, we see Rosenblatt changed their recommendation for Apple from neutral, that hold, to a buy. If we were to put things on a 1, 2, 3, 4, and 5 scale, 1 being the worst, 5 being the best, they just put it from a 3 to a 5, is what that means. In addition to that upgrade of 2 levels, they changed their price target from 160 to 189. On the same day, Bank of America Securities downgraded it from buy to neutral, lowering theirs almost the same way, from 185 down to 160. So if what you want is to get a single, if you want to see all of the individual changes to these analyst recommendations and price targets, FinViz is a really cool resource for it because they list out per company what the changes for that company have been in recent times. The next source that I want to show us is going to be CNN Business. This is probably one of the cooler sources because it's visual. I like pictures, not gonna lie. They're fun, but they also make boring data that can kind of, get a little overwhelming, or you lose significance and give it that significance back. So the next one we're going to look at is CNN Markets or CNN Business. So here we can look for a specific company. Hello, I said Apple. Now you cooperate. We go over here to forecasts. Let me make this a little bit bigger. What you end up getting is a forecast. It shows you the historical prices for the past 12 months for Apple. And then in the forecast range, you see 3 different things. These should sound familiar. You have the range for the high and the low. And you also have the median. And here is why I was saying before, why average is a pretty bad metric to look at. Because the estimates for Apple, again, we are talking one of the largest companies in the US, one of the largest companies in the world, one of the most studied stocks, and one of the most traded stocks. The range of prices is anywhere between $118, which is 17% down, or as high as $200, 40% up. The entire range that this occupies is $82, which if we do out the math, that is over 50%. That is 57.7% of the stock's price is the spread between the highest and the lowest. If we just did the average, again, this is really bad napkin math in the diner kind of thing. So don't actually say that these are the real numbers. They're not. Just as a quick example, though. If we were to say that the average between those two is what the actual average would be, we end up getting an average there of $159. That is still quite a bit short of the median, which again, the median is take off the furthest, basically take everyone and just have all the people from either side start leaving until you're left with the middle guy. That middle guy for Apple is $176. So the middle guy says 176. The most optimistic guy says 200. The most pessimistic, the least optimistic guy says 118. Now, I will go over this again in the summary, but I really want to emphasize, now that we see this on a chart, how this information can be used in really negative ways. I say this a lot. I learned this when I was in business school from my statistics professor, and it's always stuck with me because it is so true. Statistics never lie, but liars use statistics. It is very easy to do any sort of analysis and come up with any sort of data. And it is very easy to take only the piece of data that tells your story the best. If what you wanted to do was write an article about how doomed the stock market is, or even large cap established companies like Apple are still expected to lose 15 to 17%, you might just say, this low, again, example here, this low from JP Morgan shows that Apple is expected to be at $118 in the next 12 months. That's a really spooky outlook. And if that is the only thing you say, if you only say one analyst and this was their estimate, that's misleading. That's where a lot of articles, especially opinion pieces, If an article is written by one person on a forum or one person on a place where anyone can write an article, it is much more likely that they will pick out the piece of information that tells their story. Or what if you wanted to make a case that, the market's recovering and analysts are expecting huge growth for even large cap companies? Look, Apple, Juan de los Palotes research group found that their forecast for Apple in the next 12 months is $200. Pretty telling, right? It can go either way. It could be you take the highest number there and say this is the best news ever, or you take the lowest number and you scare the living daylights out of people. I'll tell you which one results in more clicks. I'll tell you which one of those results in more traffic and more interest and more conversation. It's the one that scares us. Fear is our strongest emotion. So, of course, you're less likely to see the article that is praising the 40% forecast, and much more likely to see those that are forecasting or quoting the 17% loss. Hopefully I've made my point. Scrolling down a little bit, what we get is the analyst estimates. These are not all of the estimates. These are only the ones that CNN has polled. But what they find is they add up all that information in a single chart to show us where everyone is saying they think things are. 27 estimates say buy, 5 say it will outperform the market, 7 say hold, so comparable to the market, 1 says underperform, 3 say sell. And what's really cool is you can see how this has changed over time. It's awesome to be able to see not just where these recommendations are today, but see how they've changed over the past months to really get a better idea of what are these numbers trying to tell us. Now, I haven't done this. I'm going to do this right now because I am curious. I want to see what something like GameStop is. Something that is a little less certain than just Apple. Now you give me the stock I'm looking for. Let's see. If we go here to forecasts. Interesting, right? Now we see a high of 26 and a current price of $22.62. The low is at $5, so a loss of 78%, and the median is a loss of 76.6%. Analyst estimates, there aren't many that they polled, but 2 are sell, 1 is a hold, and that number has been pretty consistent, around 1 hold, 2 sell, none in the positive range. Last one I want to check. Again, I'm curious. This is the kind of thing that you can, and really, in my opinion, should be using this kind of data for. Explore the ranges. Don't just take the highest or lowest, and if someone quotes them in an article, go and get the full story. This is not every single analyst in the world, but this is a way, way, way better idea than just one cherry-picked piece of information. Here's what we see for Tesla. A high tripling the value of Tesla. Median, 70% gain, loss, 52% loss. Low 52% loss. And despite some very questionable decision-making by one particular executive, Tesla's forecasts, or Tesla's recommendations have actually improved. Where we find that last month there were 21 buy, 5 outperform, 15 hold. Now we see 22 buy, 5 outperform, 13 hold. And no change in sells. So again, these 2 pieces of information, if you want one single company and you want to see all the recent changes to their estimates, FinViz. If you want to get everything and you want to have some pretty pictures to go along with it, CNN. Now, if you want to you don't care about a single company, you want to see all of the recent changes in terms of upgrades, so them improving the rating, or downgrades, them decreasing the rating. Wall Street Journal has a really good list, and NASDAQ has a really good list. Excuse me. Unfortunately, I lost the link for the Wall Street Journal one, but here is the NASDAQ one. And the reason that I really like the NASDAQ one is it's visual. Again, I like pretty pictures. It tells the story in a lot better terms when we have a picture to go along with it, and we can see the sizes of these changes. Now note, this does not include the price targets. This is only the recommendations. The Wall Street Journal does include price targets and recommendation changes. So if you want both, check out that. Let's bring things back and let's quickly summarize everything that we've covered today. Price targets and analyst recommendations are two key insights that are generated by an incredibly powerful and well-funded group, market analysts. These insights are meant to give both retail and institutional investors an idea of where these analysts predict a stock's price will be in the range of 12 to 18 months. These analysts are not perfect. No individual is perfect. But if we take all of this information and put it together, look at many different analyst estimates, we get a much clearer, a much more well-rounded, and an actually usable piece of information that personally I have a lot more confidence in. You will have those extreme bulls and extreme bears in any case. And I've just shown how major companies can still have such a wild spread in their price changes. 400% in the case of Tesla, from the low to the high. With that, while the ranges are valuable, while the median is valuable, be careful the next time you see a price target be mentioned in a news article, especially if all they do is they say the price target from this one analyst is this. The chances are that they have probably picked that analyst because what they're saying backs up their story. Targets and recommendations are very valuable pieces of information, but they need context. And it is not hard to take them out of context. It is not hard to only pick the ones that make your point clear. And that's not okay. But people will do it. And the reason that I have gone into so much detail about these topics today is so that you have a better idea of what the information is actually saying, how it should actually be used, and how a single analyst is not always right. More often than not, they are incredibly wrong. But the more we ask, the better idea we get. And when we have nothing else, this is still a very valuable piece of information, one that we should know about, one that we should use, but understanding how to use it properly. And I hope that is something that you've learned through today's webinar. So, thank you all so much for sticking through this. I hope you all have learned something new, interesting, or something that you can start using to not only understand the market better, but to be able to understand others' opinions of the market better. There is no opinion in the world that matters more than your opinion. Take as much information in as you can to make an educated decision. And remember that every person, as much as they'll try to get rid of their opinion, will still have their opinion be said. Take all the data you can, make your own decision, and make your own opinion as well. If you have any questions about today's webinar, any questions about anything, sectors or Sectors Made Simple related, or if you have a topic that you'd like to hear us cover in a future webinar, you can always send us an email at support@sectorsmadesimple.com. It's always great to hear from you all what information you're using to help you invest simpler. Thank you all so much. Have a great weekend. Next week is going to be a very eventful one in the stock market. So I will be here on Friday to break down next week's FOMC meeting, Triple Witching Week Friday, and talk about how all of that has changed the market, hopefully for the better. So we'll see you all back next Friday. Thank you all so much. Have a great weekend.